Welcome back. A blowout quarter for Chevron with record earnings, record U.S. production, faster than expected integration with Hess, and a new deal with Microsoft to power up a data center in Texas. Joining me now is the chairman and CEO of Chevron, Mike Wirth. Mike, great to have you. Thank you so much for joining us.
You're welcome, Maria. It's good to be with you.
Well, it was an incredible quarter. Net earnings at $12.1 billion. That was more than $6 a share. The company's highest quarterly profit in at least 6 years on revenue of $70.1 billion, up 56% from a year ago. Can you give us the main takeaways of the quarter and what we should understand best about what took place in the last 3 months?
The story of the quarter is one of consistent execution, strong production, and record U.S. refinery throughput. We had assets around the world that ran at or near full capacity. We set a production record in the U.S. at nearly 2.1 million barrels of oil equivalent per day. We had record refinery throughput with runs greater than 1 million barrels a day, an all-time high here in the U.S., and several refineries set all-time records. All of that critically important at a time when the world energy system has been stressed and the need for supplies to markets and customers has never been higher. I'm really proud of our people in the quarter they delivered.
Yeah, congratulations. And you've been investing in this period. You know, one of the highlights, obviously, was much higher oil prices. And, Mike, that's because of this war in Iran. And I want to get your take on that, because the last time we spoke, there was serious worries about security, about ships transporting through the Strait of Hormuz. What can you tell us as this war has escalated once again?
Well, I'll start with your comment about growth. Our production was up 20% year on year, 5% just since the first quarter to the second quarter. So we have been investing to grow production and bring energy to the market. The issues associated with the conflict in the Strait continue, and there are new developments each and every day. We now see not only the Strait of Hormuz, but the Red Sea and the Black Sea have risks and uncertainties. So some of the challenges have expanded. And the risks to supply are very real. We've seen demand in the world remain pretty strong, and China is perhaps the unexpected part of the story in that they've been able to reduce their crude purchases, which has taken a little bit of the pressure off the demand side of the equation as supply has had these challenges and these risks. And so inventories have been drawn down around the world, whether it's strategic stocks or commercial stocks, and the situation remains somewhat fragile and uncertain.
Well, has the Iran conflict permanently changed how you view geopolitical risk and energy security at this point, Mike? I mean, we're worried about ships transporting and actually a shutdown in shipping for these refined products.
Our thinking on this is evolving. We've seen things like that happen over the past. I've been in this industry for 44 years. We've seen conflicts in the Middle East. We've seen conflicts in other parts of the world that have created issues for our industry. The industry responds in the short term with rerouting of supplies, and I think the industry's done well in this. The United States has been a big part of the story because as the biggest producer in the world, the biggest exporter now, to meet needs of our allies around the world, the U.S. has stepped up to be part of the answer here. Longer term, I think you will see some changes in the system. We are in discussions with Iraq about potentially entering 1 or 2 oil fields there, and part of those discussions would include a framework that would allow the construction of a pipeline that would go north and then move to the Mediterranean Sea and create a pathway for that production to get to market that would not have to go through the route today, which is through the Strait of Hormuz. And so I think you will see changes in the energy system. It's a little early to say what all of them are as we deal with what's still an evolving evolving set of circumstances.
Well, thank you for that, because I know now you've got the Houthis involved. They've been attacking assets near the Red Sea. You've got Egypt. So, Mike, what can you tell us about infrastructure that has been hit as a result of this war? Is there any reason to believe that it's going to take longer and longer to get that infrastructure back in place?
Well, it depends on the particular circumstances. In some cases, the hits are relatively easily fixed if it's piping or tanks. In other instances, if it's more sophisticated processing equipment, that takes more sophisticated and specialized manufacturing to replace that equipment, and the lead times on replacing that can be months or even years in some cases. And so I think the unfortunate thing is that energy assets have been targeted in this conflict, and what that means is it degrades the capacity of the energy system to meet global demand, and how quickly that comes back will be one of the things that determines when markets actually get back to some sort of a new equilibrium.
But Mike, you've said that given this disruption, you would expect oil prices to remain elevated for some time, right?
We've seen supply constrained, we've seen damage to infrastructure, and we have new risks that I think will be priced into the market on shipping, for instance. So shipping rates, shipping insurance, and the willingness of ship owners to go to certain ports in the world is likely to remain a question for some time to come. As I mentioned earlier, the inventories around the world have been drawn down. So some of the buffers that have bought us time and allowed markets not to increase the way some feared that they might, those buffers are greatly diminished, and the risks continue to present themselves. And so I think what that creates is a situation where the price pressure is more to the upside than it is to the downside. And so I do believe that we're going to see circumstances keep that pressure in place here for a time to come.
Mike, let me get back to the quarter, which was a blowout quarter, and your company's execution. It is also the one-year anniversary since you closed the Hess transaction, and you said in the quarterly analyst meetings that you've achieved 50% more synergies with $1.5 billion in synergies. Tell me what this Hess acquisition has done, given the importance of the Guyana facilities and opportunity that you are in right now.
The headline on Hess is what looked like a good transaction at the time we did it, looks even better today. The integration has strengthened our portfolio. We accelerated financial delivery with 50% more synergies 6 months earlier than we expected, so $1.5 billion rather than $1 billion, and mid-year 2026 rather than end of year 2026. We're seeing strong free cash flow, roughly double what the incremental dividend cost is. So we used shares to transact for the company. The dividend that we're paying on that share is those shares is only half of what the free cash flow generation has been. So the transaction is accretive on a per share basis on free cash flow. We've got a bigger, stronger portfolio. It enhances and extends our growth into the 2030s. And perhaps most importantly, we've added a tremendous talent to our workforce. The people that have joined us from Hess are already making a significant contribution. They've strengthened our workforce, and this is a tremendous combination.
That is wonderful, Mike. What can you tell us about the future and how sustainable these very strong numbers are? What are you expecting second half of the year? Also about production, analysts want to know if you're going to be able to keep up this very strong production second half of the year.
We've guided to 7 to 10% production growth for the full year of 2026. That guidance remains intact. We are seeing strong underlying performance in businesses around the world and have every reason to believe that we will deliver that. That's on top of growth last year and the year before. So we feel very good about that. And the reason is the quarter was not a function of some unique set of circumstances in the quarter. We've been building a stronger portfolio for the last decade. A decade ago, a little bit more than that, our production in the Permian Basin was 100,000 barrels a day. Today, our production in the Permian is greater than 1 million barrels a day. A few years ago in the Gulf of America, it was less than 200,000 barrels a day. Today, it's well over 300,000 barrels a day. We've added a couple 100,000 barrels a day in the Bakken, 400,000 barrels a day in Colorado, in the DJ Basin. So we've steadily built a portfolio, particularly in the United States of America, that is much stronger than it was today, that's producing at a much higher level, and will continue to do so long into the future. We've guided to a 10% annual free cash flow growth over the years 2026 through 2030. So through the end of the decade, we've got underlying business improvement activities and production growth that will deliver value for shareholders and, most importantly, more energy for markets and consumers.
Yeah, I'm glad you mentioned the Permian, because I was with you at the Permian Basin and I saw Chevron's operations there in Texas, and it was incredibly impressive to see that you are continuing to tap into what has been incredibly rich content in the Permian Basin.
The Permian story just keeps getting better every year. This year, we expect to take the capital investment per barrel of oil and gas produced down by 25% from last year. And again, this comes on top of several years of performance improvements. So the story in the Permian Basin is strong and getting stronger.
You know, another part of this story that I just loved looking at with regard to the Chevron overall outlook is what you're doing with AI. Because this quarter, with your announcement of an agreement with Microsoft, tells us that Chevron is not just selling oil and gas. You're actually building AI infrastructure. Tell us about this 20-year deal that you're announcing with Microsoft.
I'm really excited about the deal that we've announced with Microsoft. We're helping power AI growth by delivering abundant, affordable, and reliable energy needed to scale AI. This is a 20-year power purchase agreement with Microsoft, one of the strongest companies in the world, for 2.7 gigawatts of capacity in West Texas. This is a behind-the-meter project. So what that means is we're not moving power through the grid and adding to the strains on the grid that are raising costs for ratepayers and creating reliability concerns. This is power that will be built off the grid, will be there to supply the Microsoft data center complex, and ultimately at full capacity will have the ability to provide power into the grid to help alleviate concerns for ratepayers. It takes advantage of the abundant Permian gas resource we were just talking about, and it's really differentiated from other announcements you see in the quality of the players involved in this, the scale. It's the largest, most advanced project of its kind, and it leverages Chevron's unique strengths. Our project execution capabilities, our strong balance sheet, our strong gas position, our long-standing relationships with people like GE Vernova and Microsoft. And importantly, we've already identified additional locations where we could do this again, and we're in conversations with potential customers about similar projects elsewhere.
Wow, that's incredible. So does a 20-year deal on AI infrastructure mean that Chevron's earnings are less dependent on the price of oil from day to day?
It's a very important attribute of this. This will be a steady stream of payments for the capacity that are uncorrelated to oil and gas prices. We're in a volatile industry. Right now, we're seeing very strong prices. 6 years ago, we saw negative prices. And prices in this industry cycle. They go up and they go down, and our cash flows reflect this. This is a project that will create a very steady stream of cash flows that will offset some of that volatility, that will hedge away some of that risk for our shareholders, and it's an interesting new model that we think has the potential to become a bigger part of our business.
Well, it's incredible. Over the last week, I've been interviewing lots of officials and executives on AI, and leaders from OpenAI and Anthropic have all told me that the bottleneck for AI is no longer chips, it's power. And that puts a company like Chevron in the catbird seat as we see this revolution underway. So is this going to be as important as perhaps any oil discovery that you could make over the years? Could this be that important?
Well, I think it's important. Our core business remains oil and gas, and the world consumes over 100 million barrels of oil every single day. And so we want to be sure that we keep our eye on what sits at our core. But this is an important new opportunity. If you think about AI, you really have the input is energy, and the output is intelligence. And in between, we've got data centers, we've got chips, we've got models, but the constraint on the system today is the power. We're helping to solve that constraint. The other thing that's interesting is you look at this and you look at past booms in telecommunications, in rail, in other infrastructure build-outs in the country. The technology in the middle sometimes cycles. There are early leaders, there are later companies that succeed, but the infrastructure is built and it's enduring, and it's where there's a lot of important value created. In this case, we're building 20 and 30-year assets that will endure through whatever happens with chips, which have a shorter life, continue to evolve with the companies, which likely will, have their own competitive dynamic that unfolds over this time. But a constant will be the need for that power, and that's the part of the chain that we're investing in.
Well, that's right. And that's what I'm wondering, if the Wall Street community understands that in terms of the sustainability, the strength, and the power of this deal. And you just suggested you're going to have more deals. Are more deals in the works with the hyperscalers to power up data centers, Mike? And do you think investors are valuing this properly, given the potential for growth?
There are conversations underway. We've identified a number of additional locations. We've actually secured some of those locations and have begun early works on those. We're in conversations with a number of different large customers, the largest companies in the world. And I expect that you will see more deals. I think investors are just beginning to understand what that might mean for our company. I think they are interested to learn more about this and to see what other deals we can put together. But I think they're just now beginning to understand what it could mean.
Yeah, it's very powerful. Mike, did I miss anything that you'd like to add in terms of where Chevron sits today after this very strong quarter you've reported?
I think the one thing that I would mention is we've seen the administration take some actions that have been very helpful to markets. The Strategic Petroleum Reserve release has helped create supply. The waiver of the Jones Act has allowed us to move crude oil and products around the United States to markets where it's needed. There have been some specification relaxations, which creates more supply. And so the policy actions that have been taken are the right ones. They're the ones that allow the market to work better and allow industry to move products to where they're needed. And I think there have been voices that have suggested other actions which have not been taken, some of which I think would not be helpful. And so we continue to work with governments around the world to meet the moment, and we're committed to doing everything we can to get energy supplies to a market that desperately needs them.
All right. Well, President Trump has been walking this balance to try to end this war in Iran and get oil prices lower before the midterm elections, while also encouraging Congress to codify some of those executive orders with regard to permitting. Mike, is there anything you think the administration or the Congress should be doing differently in terms of codifying those so that things don't change every 4 years with a new president?
I think the biggest thing that Congress could do is pass permitting reform. This has been talked about for a long time, and there's something in it for everyone. If you like wind and solar, permitting reform is helpful for more renewables development. If you believe the grid is a problem, permitting reform is necessary for us to modernize the grid. If you believe oil and gas and pipelines are also part of the solution, permitting reform is essential there, because the current system has been weaponized to stop development of our industry. I think the administration has been a champion of unshackling free markets and allowing investments to flow into our economy, and we need to get a permitting system in place that enables that. And so I think that's the single biggest thing that could be done.
Understood. Congratulations on the great performance and execution, Mike, and thanks so much for being here.
Always good to be with you, Maria.
Good to see you. Mike Wirth is Chairman and CEO at Chevron. We'll be right back. You're watching Mornings with Maria, live on Fox Business. Stay with us.